Option chain is like the blueprint of the option market. It tells us everything about the trading action happening in the market. So this is the option chain for Indian stock market index Nifty. Few important things to note here. You will see the symbol of either the stock or the index right here. This is the spot price. And here you will again see a drop down menu which will tell you which are the indexes to choose from. So you can see all the Indian sector indices. This is the main index, then this is the banking index, the IT index, and so on. You can even see for S&P 500 and FTSE 100 here. And if you want to select the option chain for any of the stock, you can just type here and you can filter it down to looking at the option chain just for a specific stock. This here shows the expiry. Now let's look at this table. This table is divided into two main parts, the call side and the put side. And in between, we have strike prices. So on the call side, let's begin with the first column, which is open interest. So open interest is simply the number of active contracts in the market, and change in open interest, which is the next column here, it reflects what is the net change in the open interest compared to the close of the previous trading session. And the next column shows us the volume. So it will give us the open interest, change in open interest, volume, all at specific strike prices. Then this column here will show us the IV, which is the implied volatility, and it will give us again implied volatility at a specific strike price. So wherever we see that the implied volatility is blank or there is no volume here, it basically says that these strike prices are illiquid. There's hardly any trading happening here. There's no trading volume here. So there was no mechanism to discover the implied volatility. LTP stands for last traded price. And this is the net change in the LTP. What is the day to day change of the LTP? And this is the bid quantity, the buyers of this call. What is the quantity? What is the best quantity which has been bid? And this is the best bid price. And this is the best ask price. The ask price is the offer price from the seller, what the seller is asking, and what the buyer is willing to bid against that. And this is again the ask quantity by the seller, and it's identical on the put side. On the bid ask spread, all you need to take care of is that you're trading strike prices which are liquid, and the liquid strike prices have a low bid and ask spread, and the bid and ask spread is the difference between the bid price and the ask price. And LTP here is again very dynamic. It reflects the last traded option price, and this option price at expiry will only have the intrinsic value, and during the life of the trade, during the life of the contract, this LTP will keep on changing dynamically based on option creeks. Okay, next you will see that the top part of call section is highlighted in yellow, and the bottom part of the put side of the table is highlighted in yellow. So yellow here represents the options which are in the money. So you will see that whenever the spot price, and this is the spot price 11,360. So whenever the spot price is greater than the strike price, call options are highlighted in yellow as they are in the money. And whenever the spot price is less than the strike price, put options are highlighted in yellow as they are in the money. Now let's look at the highest open interest on call side. So we will see this is the open interest column. On the call side, we will see that the highest number of open interest is is here, 3.1 million contracts, and it is at a strike price of 11,500. Whereas on the put side, the highest number of open interest is here, 4.9 million, and it is at a strike price of 11,000. Since option writers are largely big institutions, because writing an option requires margin money, it's like a security deposit. So since writing an option requires a lot much more capital than buying an option, Lot of these option contracts which have been written here at different strike prices, they are written by large institutional players. So when institution players are choosing a strike price of 11,500 on the call side and 11,000 as a strike price on the put side for writing the maximum number of contracts, it reflects what is the price ceiling and what is the price floor. So as a call writer, if I'm writing an option at a strike price of 11,500, what does it mean? It means that as a seller of option, I'm expecting the spot price to remain below the strike price. And as a put option writer, if I'm writing a put option at a particular strike price, it means that I'm expecting the spot price to remain above that strike price level. So this tells us the range of what is the resistance, so what is the ceiling, and what is the floor or what is the support that institutional market writers or the big players are expecting in the market. Next, we look at change in open interest. So, change in open interest tells us about the change in sentiments among the market participants. So, if you will notice around the current spot price of 11,360, we take the next highest strike price, which is 11,400. At 11,400, we see that there are 2.7 million calls which have been written and 876,000 puts which have been written. However, in terms of the change in open interest, there is a net withdrawal of 137,000 calls, and conversely, there is a net addition of 248,000 puts. So, this indicates that even though call writers are dominating the put writers, but the confidence of call writers at this strike price is weakening, which is reflected in net deletion in open interest and reflected in the net addition of open interest on the put side. So this means that even though bears are ahead on 11,400 strike compared to bulls, but bulls seem to be surging ahead and bears seem to be withdrawing. So call writers are referred to as bears because they are taking a stance that the spot price is likely to remain below a particular strike price, and conversely, put writers are referred to as bulls because they expect the spot price to remain above a given strike price. Now we can also compute a ratio of the total number of puts written divided by the total number of calls written to compute a ratio called PCR. And a PCR value less than 1 indicates a bullish trend in the market, and greater than 1 indicates a bearish trend in the market. However, we cannot just rely on a PCR value to gauge the direction of the market. Alright, in the next section, as a part of this video itself, we will look at a live option trading. And a live option trading will actually reveal how the open interest and the change in open interest is changing in real time and what it can tell us about the near term price action and in terms of the support and resistance at different price levels. Now, one thing that you will notice as we get into the live action is that they are recorded at two different times. However, what we need to pay attention are really the concepts. Okay, this is a live option chain of Nifty. Nifty is an Indian stock market index. We are in the middle of trading hours. Right now it's 1:13 as you can see here. This is the current spot price. So we are very close to a strike price right now of 11,000. And let's see the action on 11,000. So the number of puts are about 3.7 million and the number of calls are also 3.7 million. So it's even Stevens. It's very balanced in terms of the total number of puts and the total number of calls which have been written. So let's see what is the delta, what is the change which is happening here. So the new puts which have been written so far at this strike is something that you find here under this column change in open interest. And this is something that you can see in real time when the trading is live, as is now. So there are 336 new puts which have been written compared to that 432,000 calls which have been written here. So it's very balanced, very equally balanced between the put writers and call writers at this strike price. So the price is, the price is just hovering around a strike price of 11,000. It can go up, it can go down, depending upon whether the number of puts suddenly go up or the number of calls dominate or which side starts closing a few of their open positions. We'll get to see that. Let's see where is the next big resistance coming up. So on 11,100, we are seeing almost 2.9 million. We are seeing 2.9 million, very close to 3 million calls which have been written. And compared to that, the number of puts are just about 690,000. So we know that on 11,100 strike, the call writers seem to be far outnumbering the put writers. And as a matter of fact, there are some 99,000 put positions which have already been squared off here. So we know that this is a very strong resistance level. Call writers seem to be far outnumbering the put writers. And even in terms of the new calls which have been written, there is a positive addition of 289,000 compared to 99,000 puts which have been withdrawn at a strike price of 11,100. So this represents a very strong resistance. And if you were to go down, let's look at 10,900. We have 4 million puts which have been written here. Compared to that, there is just about 1.9 million calls which have been written at this strike. So it's more than two times the number of calls uh, that we are seeing in the number of puts at a strike price of 10,900. So clearly, the put writers seem to be clearly dominating 10,900. So when we are seeing a resistance at 11,900, we are also seeing a very significant support at 10,900 because the put writers are dominating here. So this gives us a range as to where are the put writers dominating and where are the call writers dominating, and this gives us a very nice range between support and resistance. So right now we know that the price action is likely to play out between 10,900 and 11,100, unless and until there is a very significant change in the open interest from either of the sides. So this gives us a good range. So we know that the first support, significant support, is at 10,900. We are about 89 points away, and this is something that we can keep refreshing in real time. So we are about 85 points away from 10,900, but we know that there is a very strong support here. There aren't any new number of calls which are being written, so we know that the put side is heavily dominant on 10,900. But let's see what is happening on 11,000 now. Since every second this is changing, so okay, it is still very even Stevens. 3.7 million against 3.7 million here, and the number of new calls which have been written here is slightly ahead of the number of puts here. So the call positions and the total number of open interest in the put position, they seem to be very balanced right now at 11,000, and we virtually seem to be having a price stability out here. So for any new price, significant price change from this level at a strike price of 11,000 would entail there has to be a significant momentum on either the change in open interest on the put side or the change in open interest on the call side for the price to go in either of the directions. So this gives us a fairly good idea as to where we are and where the price action is currently being played out. So we know that the price action is currently being played out in this range of 10,900 and 11,100, and within this range there seems to be some kind of a near-term equilibrium around the strike price of 11,000. And also in real time, we can see how these institutional writers are changing their position, they're changing their stance. So we are back at 11,000, and it's still the same. We aren't really seeing any addition on the number of calls or the number of puts which are being written at 11,000. So this almost brings about an equilibrium for a price, even Steven. So for a price to disrupt from here, either on the lower side or on the higher side, one of these guys, either the call writers or the put writers, have to significantly change their positions and take the price in their direction. And please bear in mind that a lot of these option writers, they are institutional writers who are also the market makers. So it helps to see how is the price action being played out in terms of a battle between the put writers and the call writers.